wanted to ask about the framework review again. Would a shift of focus to inflation over an average period, would that call for a different policy stance if you made that shift? And whether or not we know the answer to that question, would the Fed consider changing the stance of monetary policy for that reason, even if there was no change to the economic outlook?
Well, as you know, we're comfortable with our current policy stance. We think it's appropriate. We think it'll remain appropriate as long as data coming in are broadly in keeping with our outlook. Over time, though, let me take a step back. Over time, an average inflation targeting framework would be different than a current framework in the sense that it wouldn't be there would be some aspect of trying to make inflation average 2% over time, which means if it runs below 2% for a time, it has to run above to bring the average up. So that is a different framework. Our current framework is one where we say we would be equally concerned with deviations of inflation from target on either side. But that doesn't suggest an intention specifically to have those deviations be symmetric. In other words, consistent with that would be having all the deviations be on one side, which is what we've had actually. So I think it is a change in framework, and over time it would lead to a different approach to policy. Again, I'm not trying to I don't want to comment on the current stance of policy, which we do think is appropriate.
Don Lee with the LA Times. Wanted to ask you about the stock market. By historical comparisons, as you know, valuations are considerably high, and just wonder how much discussion and concern you and your colleagues have about that, and what risks do you see for the economy?
So we look at a very broad range of financial conditions. There isn't any one financial condition that we look at, and when we look at financial conditions, what matters for the real economy is substantial changes or material changes in financial conditions that are sustained over a period of time. If I can, maybe I'll answer that in the context of our overall financial stability framework. That's one way to look at it. So when we look at financial stability, we've got four pillars to that. The first of which is leverage in the financial system. That is at a comfortable level. Our banks, particularly our large banks, have high levels of capital. The second is leverage in the non-financial sector, and that divides into households and businesses. Households' debt to GDP has been coming down since the financial crisis. It's not moving up. It's at low levels compared to what it was before the crisis. So not every household, but in the aggregate, household debt is in a good place, a very good place. Business debt has been moving up. We've been calling that out for more than a year, substantially more than a year, and it's something we're focused on, and we've taken appropriate measures and are monitoring carefully. But we think it's not something that would threaten financial stability, but more be an amplifier. The other one is asset purchases. Asset prices. Getting to your question, we do see asset valuations as being somewhat elevated. I do, somewhat elevated. If you look at risk spreads, they're narrow. If you look at PEs, they're high. I think the way to think about one way to think about equity prices, though, is what's the premium you're getting paid to own equities rather than risk-free debt, and that's also at fairly low levels, but not extremely low levels. So valuations are high, but not at extremes. The final factor is funding risk. Are big financial institutions and other players in the financial system funded with stable funding, or is there a lot of run risk? And the answer is very stable funding for the most part. So if you look at overall, what you see, in my view, is vulnerabilities to financial stability are moderate overall.